Are you worried about a stock market crash? Frankly, I don't blame you if you are. There's a lot to worry about right now. So in today's video, I'm going to share with you some steps that you can do so you don't have to be worried about losing it all if the stock market does crash. But before we go there, I want to thank this video's sponsor. It's Chapter. They help people make good Medicare decisions. More on Chapter later. Thank you, Chapter, for sponsoring the video. Okay, let's jump into Investopedia. And we're going to start off with a little bit of history on bear markets. And the reason why history is important is there's two reasons that people get in trouble with bear markets. One is just the sheer depth, how much the market goes down. That causes a lot of pain. And then the other one is how long bear markets, negative markets tend to last. Because if we can navigate those two things, over time, we're likely going to be fine. I want to open and say this isn't financial advice. I don't know your situation, but I think these are good things to have on your radar screen. Okay, so according to this article in Investopedia, between 1947 and 2022, there were 14 bear markets, and they ranged in length from 1 month to 1.7 years, and ranged in severity from a 51.9% drop, over 50%, that's a staggering number, to a decline of 20.6%. And this is according to an analysis by First Trust. They've got a great chart I'm going to share with you later. But let's start with this chart here first. This is from Investopedia, and there's a lot of data here. So I want to share with you first what we're seeing. On the left, this is for the S&P 500. On the left side is the date, what the event was, and whether it was correlated to a recession or not. If you see an R there, it means it happened during a recession. And then it shows you what the decline was. So you can see that negative 21.6. And then you can also see a negative 56.8%, almost 60%, 60% during the Great Financial Crisis, October of 2027. Then you can see how long the market was going down, and also how long it took for the market the length of the recovery, how many months the market was going up. And those are important too. And one of the key takeaways is look how long the market tends to go up versus the market going down. This next chart coming up is going to share it. But first, I want to talk about a couple of these things. What really hurts people is the decline in the length of decline. Look at like January of 1973, almost a 50% drop. And it took 21 months until the stock market quit going down. That's a long time to wait for the stock market to go down. March of 2000, one of the reasons the dot-com bubble bust was so hard for people is just how long the market kept going down. It went down for almost 3 years. That's a long time to wait. You know, first you get the first negative year return. You say, this kind of sucks, but I know it's part of the game. Then you get a second year and you say, okay, well, I've been unlucky, but historically, it's much more, as we look at this data, there's nothing here over 24 months of the stock market going down. So you get the second statement from the second year and you're like, okay, I'm through the worst of it. I should see a positive year. But you know what you saw? You saw another negative year. So it's those things that make it hard to make good decisions. And next, I want to show you this chart by First Trust that goes in and gives us a lot more important insights and graphically shows us how long historically the negative, how long the pain lasts, how long the market's going down. But before we go there, I do want to talk about making good decisions, not just with the stock market, but also with our healthcare and with our Medicare, which is why I'm proud to sponsor with Chapter in this video. Chapter provides free Medicare advice to you and I, to consumers. And what I like about Chapters is several things, but really two things. One, having the right data is so important. And my understanding from the Chapter team is a lot of the raw data from Medicare, it's difficult to know whether the current data is accurate or not. And so the team at Chapter are data experts first. And how they started the company was really making sure they had great data. So when they tell clients, this is the plan that's going to best line up with your prescriptions, this is the plan that's best for your situation, they know that they have good data to back that up. The other thing is you want your Medicare advisor working for you. You want them to be an advocate for you, not for the insurance companies that pay the insurance. And that's why I met with the CEO. That's why I met with several of the team members, is to get a sense of that. In my sense, is they've very much structured the company so that everybody's on board, that they work for the consumer. They're not working for the insurance company. So thank you, Chapter, for sponsoring this video. You can find out by calling more about Chapter by calling this number, scanning this QR code, or going to the link that will be in the description that's here on screen and also will be in a pinned comment. Okay, so let's look at this chart, this wonderful, wonderful chart by First Trust. And the blue are the bull markets. And what I want to show you is just the height, the amplitude on the positive side there, and also the breadth, how long that lasts, versus in hindsight, what looks like blips with the market going down. Now, when we're living through a blip, it's very, very painful. But this just graphically shows you that, time in the market is our friend. Our best tool to succeed as investors, to buffer out the volatility, is not timing the market, but it's our time in the market. Okay, now that we have the foundation, I want to introduce you to two articles that give thoughts on, how we should weather bull markets. What advice do they have? And the first one is from NerdWallet, and their article is called "What to Do When the Stock Market is Plummeting." And the first thing is and I think this is a good point, to know what you own and why. Right during COVID, we all got sent home. It looked like things could really get ugly. But the reality was, for some companies, it was really a tailwind, not a headwind. For instance, laptop makers, we all had to go home. My laptop was 10 years old at the time. It was fine for checking email at night, but it wasn't fine as my main machine. So for hardware companies, many of us had to upgrade. For companies like Costco, for companies like Amazon, that could deliver food to our home, that provided bigger locations where we could space out more. It was really a tailwind for those companies as well. So it's important to know what you own and why. It's also, a quick aside, I'll also say, it's important to go through this before there's a crisis, right? When there's a crisis, it's hard to be thinking calmly. It's hard to be thinking rationally. It's hard to make good decisions. But when it's calm, that's the perfect time to look at your portfolio and make sure that it reflects your reality, that it's a portfolio that you can stick with, not just in good times, but also in bad times. But importantly, to do this when your mind is calm and you're not freaking out, okay? So the first one is to know what you own. The second one from NerdWallet is to trust in diversification. Diversification should be your friend. Unfortunately, there's something called correlation breakdown, which is when you need diversification to work the most, is when everything correlates to one and everything goes down. And that can happen when things are scary. We saw that happen in the great financial crisis. Okay. The next thing that NerdWallet says is consider buying the dip. Maybe that's something that I personally would disagree with. Think about getting a second opinion. I strongly agree with this one. Right? Having an advisor by your side is really important. Having a relationship with an advisor for years before you need that advisor in scary times can be really valuable. If you don't have an advisor by your side, I'd encourage you to think about reaching out to somebody during scary times. Okay, and the next one is just focus on the long term. It's hard to do in the moment, I know, but history has shown us that not only do trees not grow to the moon in good times, but you know what? Bad times don't last forever either. Eventually, the sun rises, the storm subsides, and better times are ahead. Okay. I also want to share an article by Forbes. It's called "How to Survive a Stock Market Crash." They start off with a disclosure saying this is not personal advice. I agree with that. But, they talk about similar things, diversify in different sectors and countries, diversify into other assets, and consider investing in a total return fund. Again, these are the things that make sense to do sooner rather than later. It also makes sense to be sure that you're dealing with people that have good information in your best interest in mind, which again is why I'm proud to partner with Chapter. Thank you again, Chapter. YouTube says this is the next video of mine that you should watch if you like making good decisions, if you like my videos. I'll see you in the next one. Bye-bye.